The big thing. Last year was talking about austerity. This year we're going to see how people like living under these austere conditions, and they're not going to like it. And that's why you're going to see riots across Europe.
Okay, so obviously in Europe, this is where we've seen a lot of budget cuts, tax cuts, wage cuts, all of those kinds of tax rises, those kinds of issues. It's now raising this question of inflation. Certainly it's starting to be pervasive in the United Kingdom. It's an issue in China. It's becoming an issue in South Africa. How's inflation going to impact on growth? Inflation's
a big issue. I mean, if you're printing a lot of money, you are going to cause inflation. Inflation does reduce your debt to an extent, so it's useful from that perspective. The problem with inflation is that, first of all, it's being driven by things that raising interest rates won't help, like food prices, possibly oil prices. And then also, if it makes interest rates go up sooner than expected, we've got a problem. The world is recovering, the global economies are feeling better, but they need time to work through the problems. If interest rates start going up prematurely and start going up steeply, we've got a problem going forward.
How will this issue of interest rates impact on investments in fixed income instruments, for instance? Because what we've seen in early 2011 already is a major sell-off of South African bonds to the tune of about 7 billion. It's issues to do with Egypt, it's issues to do with fears of inflation in China, and it seems as though whereas last year everybody was looking for yield in emerging markets, now everybody's looking for yield back in traditional markets.
Well, first of all, I think that you're going to start seeing interest rates going up across the world. So that yield gap that we had in South Africa, where our yield was so much higher than everyone else's, is starting to diminish. But I think certainly this year is going to be you're going to see a far more equitable spread of the world's capital. Last year, emerging markets almost had the monopoly on growth. It was a one-way bet. I think what things like Egypt are doing is that people are starting to look at emerging markets and say these guys actually need a bit of a risk premium. On top of that, emerging markets have become expensive, whereas the developed market equities are looking a lot more reasonable. So you're starting to see flows going back into the developed market, which I think is good. Emerging markets probably still will outperform from a growth perspective. Emerging markets will remain attractive, but by diversifying the flows into the developed world as well, what you're doing is you're releasing some of that pressure on what could have become a bubble situation.
Obviously, the emerging market that everybody has hedged their bets on has been China, seen as the catalyst for global growth. But with inflation now nearing the 5% mark, 3 interest rate hikes in the last year alone, there are concerns about what inflation is going to mean for sustained growth in China. Or is that not a concern?
No, it's a big concern. The Chinese growth, they've done a variety of measures. They've reduced stimulus, they've raised interest rates, they've cut back on areas that were overheating, like housing, lending, in order to try and slow their economy down. They want to get it somewhere between 8 and 9%, but despite all of that water that they poured on the fire, still it grew at 10.3% last year. So going forward, they're going to keep trying to slow it down to somewhere between, say, let's say 7 and 9. The risk is that you get rampant Chinese overheating, because then there's a risk that they pour too much water on it, and if they put the Chinese fire out or slow the economy down too much, then the world will feel it significantly.
How will Africa feel it? Because so far China's been a major investor on the continent and a major buyer of African commodities.
Yeah, we don't see a Chinese growth collapse at all. They are trying to manage it, and they probably will get it more or less right. So I wouldn't count on a Chinese collapse at all. The Chinese will probably continue growing and continue growing reasonably strongly, and that, as you say, is driving the continent. It's amazing to see the impact on the continent. If you look at the Economist figures for the top 10 growing countries in the world for the first 10 years of this century, 6 of them were Africa. Going forward for the next 5 years, 7 of them are African, and that is the Chinese influence.
But with events in China unfolding, would it change the investment relationship to the extent that China has been entering into arrangements where, in exchange for commodities, they give concessionary loans, soft loans? If China's facing its own sort of restrictions, and Chinese investments are facing their own sort of restrictions from the Bank of China, would that change the dynamic of how Chinese capital enters Africa and the conditions that are set?
Sure. China coming for Africa is based on their red-hot economy needing the things that we've got. They're doing a variety of different deals. They're paying off debts of emerging markets. They're lending money to emerging markets, all of which is good for Africa. They're rebuilding Africa's infrastructure. And if commodities is the price that we have to pay in order to rebuild that infrastructure, then maybe that's what it's going to have to be, because other industries, telecommunications, financial services, tourism, all start to take off as a result.
All right, we've spoken about austerity in Europe, inflation rising in Asia. The situation in the United States, we saw weaker than expected retail sales figures, but that doesn't change the general bullish sentiment about America at the moment. Experts expect that economy to grow in the region of 4% GDP Q1 of this year. Sure,
America's looking better. They're going to grow nicely this year. The Dow Jones is back at levels, almost sort of May 2008 levels. Deal activity is back to the boom years. So looking better, but one has to now see how much of that was driven by quantitative easing and unsustainably low interest rates. But certainly America is looking better, and growth may outperform on the upside rather than the downside.
You raise an interesting point when you say that a lot of that is driven by activities by the Federal Reserve. There's still the big issue, which was the crux of the problem in America, had a lot to do with mortgage securities and credit flow. Has any of that changed? Do we see a tide changing?
It is changing, but it's working its way through the system. It's going to take a long time. When you have a housing crisis, when you have a mortgage crisis, it's got to work its way through. Something like 25% of American homes are suffering from negative equity, i.e. the bond on the house is worth more than the house. That's a big number. And until they can get that down, until they can slow down the foreclosures, it's going to be a problem. But that will take time. They're certainly heading in the right direction. Okay, the debt is a problem, though.
All right. Once somebody sort of calibrates all these issues that you've raised and they look at South Africa in this space, a weaker rand, inflationary risks that have been pointed out for us, high commodity prices, how do all these factors come together and influence any decision that an investor must make?
South Africa is still reasonably well positioned. We are not living beyond our means, and I think that's the big difference. Government don't always spend the taxpayers' money as efficiently as they could, but they're very good at collecting it, and they're not borrowing to fund a welfare state, and that is what differentiates us. That's what's seen us get some upgrades from rating agencies. SA equity market overpriced probably, but going forward we're going to see strong earnings growth. The SA consumer's been stronger than expected, and that'll translate to a forward price on the Johannesburg Stock Exchange that'll be reasonable.